Hi, I am Mahmoud Alkudsi, alias as Senior Market Strategist. In this two-part video series, we will explore key concepts and essentials regarding reversal patterns in technical analysis. In part 1, we'll focus on what reversal pattern is, what are the different types, and how to trade using these types. These patterns can provide signals to identify potential entry and exit points in the market. So let's get started. What are reversal patterns? Reversal patterns emerge following a clear trading trend and signal the potential reversal of this trend under specific conditions. There are three primary market trends: the downward trends, the upward trends, and the sideways trend. An upward trend forms as the price forms higher highs with higher lows. Bulls are in charge. A downward trend forms as the price forms lower lows with lower highs. Bears are in charge. A sideways move forms as the price forms lower highs with higher lows, and here no one is in charge. So, for a reversal pattern to be applicable, it must be preceded by a clear trend, whether bullish or bearish. If the trend is upward, it reverses and shifts to downward and vice versa. However, in the case of a sideways move, we cannot confirm the application of this pattern because there is no distinct trend to be reversed. What are the types of reversal patterns? Head and shoulders and inverted head and shoulders pattern, double top and double bottom pattern, triple top and triple bottom patterns. Let's start with the head and shoulders pattern. This pattern is considered bearish, signaling a potential price decline if its conditions are met. The price forms the shape of shoulders and a head. An essential aspect following this formation is the possibility of drawing a neckline connecting the rebound after the right shoulder and the rebound after the head. How can I utilize the head and shoulders pattern in trading? To utilize the head and shoulders pattern when trading, it is best to gauge the distance from the head to the neckline and replicate the same distance from the bottom of the neckline to ascertain the potential price target for the pattern. If you wanted to enter the market, you could place a sell trade after the price breaks below the neckline level. However, it is essential to note that you should place a stop-loss order above the neckline level for risk management. Sometimes the price breaks below the neckline and before reaching its target, reverses its direction and trades higher. Nonetheless, it is important to note that as long as the price remains below the neckline, the head and shoulders pattern is considered valid for application. So, once the price rebounds from this line and resumes its fall, it is possible to place a sell trade in case you missed the first sell opportunity when the price broke below the neckline. And here an example of the head and shoulders pattern. The inverted head and shoulders. This pattern is regarded as bullish model and shows a potential price increase if its conditions are met. This pattern is characterized by the formation of inverted shoulders and a head in the price. An essential aspect following this formation is the possibility of drawing a neckline connecting the rebound after the right shoulders and the rebound after the head. How do I trade using the inverted head and shoulders pattern? To trade using the inverted head and shoulders pattern, you can measure the distance from the head to the neckline and replicate the same distance from the top of the neckline to ascertain the potential price target for the pattern. If you want to enter the market, you could place a buy trade after the price reaches the neckline level. However, it is essential to note that you should place a stop-loss order below the neckline level for risk management. Sometimes the price breaks above the neckline and before reaching its target, it reverses its direction and trades lower. Nonetheless, it is important to note that as long as the price remains above the neckline, the inverted head and shoulders pattern is considered valid for application. So, once the price rebounds from this line and resumes its rally, It is possible to place a buy trade in case you missed the first buy opportunity when the price first broke above the neckline level. And here an example of the inverted head and shoulders pattern. That's all for this video. Thank you for watching. Watch part 2 to learn more about reversal patterns in technical analysis, or you can check out our other videos where you continue to learn about different aspects of trading.